Welcome to the What to Watch video update. This is a video that I do once a week. When I originally started this video, I thought I was going to do it on an as-needed basis, but it seems like for now anyway, once a week has been plenty. I have a list of positive things and a list of negative things, and this is whittling down those things that I'm really watching as of Monday, July 1st. I do a number of different videos. I do a daily video, I do a weekly video, I do an intermarket analysis video, I do a deep dive video where I go through the charts that I'm not really focused on right now, but sometimes we have to dive a little deeper to see if there's any meaning coming from those charts. And then this video is the last video where I really hone in on what I think is happening in the market right now. Just to let you know, I do have a thing called the SPX investing program. It launched the beginning of June. I'm going to be locking it down a little bit more in July. Feel free to check that out. There are courses there. I'll be rolling out lots more. You have early access to the daily videos. I'll be also posting a number of different videos that I don't release publicly. I'll also have some position ideas and trades that you might consider. We have a whole portfolio based on the S&P 500 that we track and look at different strategies that we can implement in up, down, or sideways environments. If you want to learn more about this, there is a link below this video, either on YouTube or Rumble, to get you to that website. There's also a link in the description that will take you to a playlist on YouTube. And there's also videos on Rumble that kind of go through the program and what's involved with that. So if that interests you, please feel free to check that out. First, we look at the positive side. Okay, now on a trending basis, we're still positive, not really strong right now on the positive side, but we are trending. This is, to me, a primary indicator. This is what I base everything around. Are we trending? Are we not trending? What's the strength of that trend? And then are we positive or negative with that trend? On this chart is a thing called the ADX. And I have to turn on my pointer here. I don't want to start this video over. This is the black line right here. And when this line's going up, that means the trend is getting stronger like it is right now. You would know it by the last week or so where we've been chopping sideways. And then I put a moving average on here just to give it a little bit of context. When we're above the moving average and going up, that means that we are in a strengthening trending environment. So that we established that. Now, is it positive or negative? Well, we have a green line and a red line. And it's kind of hard because these lines are right on top of each other, but the green line is on top, so we default to positive. We've been seeing the green line coming down, and that's been a little bit of a concern. We want to see it go up. Well, after Friday's session, even though we were down with the S&P, the green line did start to turn back up. Right now, this is positive. We need to see more follow through upside from the S&P to remain positive with this chart. Then we keep a close eye on the VIX. This is the fear gauge. When the VIX is high, it's time to buy because the market's going down, even though it won't feel that way. And when the VIX is low, it's time to go, even though we're at a top possibly at those points, and it won't feel like the right thing to do. But this is gauging how is the market feeling overall. I have a number of different charts that I look at where I measure sentiment. And this is still giving us quite a low reading. We did tick up a little bit on Friday, but we're getting low readings overall. The line chart here is the closing value for the VIX on a daily chart. I also have a bar chart down here to give us the range between the open, high, low, and close. And we are getting pretty low readings overall. We also have this other thing called the VIX of the VIX. It's like a VIX that measures what the VIX is doing. And this is actually declining, which is kind of surprised. We saw the bar coming down, even though we were unchanged on a closing basis. Typically, what will happen on a down day, which is what happened on Friday, the VIX of the VIX will go up as there's more volatility kicking into gear. We actually saw this trailing off just a little bit. Now, Tom Bowley, who's connected with stockcharts.com, he's also connected with another site called earningsbeats.com. And I don't know Tom Bowley. We've never exchanged anything. I've just looked at some of his research. He went back and he said, okay, what happens with the S&P 500 when the VIX is at certain levels? And what he did, now these numbers here are from about October 2023 when he first released this. But the chart that you see here is a weekly chart of the VIX, and we're getting down into this dark green area right now. When we are really low, remember when the VIX is low, it's time to go? Maybe not always. We're getting a low reading right now. We're at 12.44 with the VIX. And if you annualize the returns, that is where we see the strongest returns for the S&P 500. If the VIX goes up a little bit into this lighter green area, we still see very positive returns, but they really chop down from what we were seeing before. And as the VIX goes up, we're still positive if we're under 20, but we're about in half of the annualized returns. This red area up here is when the VIX goes above 20, and that's when we start to see negative annualized returns here. And so we're in a spot right now in the dark green area where this tends to be the most healthy thing for the market. But we also keep an eye on the direction of the VIX, and I use a momentum study, the MACD, which is very popular. You can put it on stocks, indexes. Well, here it's on the VIX itself. We have been going up with the momentum of the VIX. And when the VIX is going up, that typically means the market is going down. Well, we've dropped down a little bit here over the last few sessions to get a very low reading for the VIX, but we haven't quite crossed over the moving average here with the MACD. So this is still in an uptrend until we actually cross below this value. Then we look at some internal measures of the S&P. And there's some positive things here and there's some negative things here. First of all, even though this is on the positive side, you notice that the advanced decline line based on price, we have not been able to surpass this previous high set back in May, even though the S&P has been setting recent all-time highs. And in fact, on Friday, when we gapped higher, we set an all-time intraday high, not a closing high because we closed pretty much at the low. But we want to see this going up and actually surpass this previous high that we see here. Now, the fact that we were down on Friday and we still ticked up a little bit with the advanced decline line, that is positive based on price. Now, another positive thing that I'm seeing here is the advanced decline line based on volume. It has been going sideways, even as the market's been going sideways. And this tells us we're above the moving average, that volume for right now is holding up. We're not seeing an awful lot of volume going into selling. We might be seeing price dash around a bit more, but volume has been hanging in there. And you'll see that with some of the other charts as I go through some other studies that look like this. Then we look at another internal measure. This is the new highs minus the new lows. And we're not seeing a real expansion of the new highs, but they did go up. And a lot of that was the positive open that we saw on Friday. But we're seeing a lot higher number for the new highs and no real expansion of any new lows. Then I plot a 5-period moving average down here. We're trying to turn back up. It's not really convincing. There's not a lot of real conviction behind it, but it is trying to turn positive. We're also flattening out and trying to go back up with our 10-day moving average. So for right now, until these roll over and until we see a contraction of the new highs and an expansion of the new lows, this chart still remains positive. And this is a pretty good internal measure of what's going on inside of the S&P. Then we look at some advanced decline ratios. A 19 period, that's blue, that's the short term, and a 39 period, that's more intermediate term. And after dropping below zero here and turning negative, even with the down day we saw on Friday, we're just barely positive. You can hardly see the red line here, but both the blue line and the red line are slightly above zero. That's positive. Accumulation distribution is a smart money indicator. And this takes into account volume, not only whether we're going up or down, it also looks at how much volume is going into buying or selling. And this is another primary indicator. We are coming down because we had the down day on Friday, but we're still above the red line, which is a moving average, and the moving average is still going up. So as long as we're still above, this is still taken as positive, but we want to keep an eye on this. If we start to drop below the moving average, that could turn things more negative. Another thing that we look at is the same kind of an approach with the 19-day advanced decline ratio. This is based on price on top, and we're just barely positive up here. And that's what we looked at, a chart representation with the blue and the red line. Well, we can also break that out based on volume, and we're looking a little more positive here. We're a little farther above zero, so that also suggests that volume is holding up for the time being. This is the Chaikin money flow, another smart money indicator where it's positive, but it has been declining. And the red line, which is a moving average, has been declining as well. To be more positive, we want to see this going up and the red line also turn and go back up. The Chaikin oscillator, another smart money indicator, we're above zero, so we're positive, but lately we have been declining here. We want to avoid going below zero. That would turn this indicator negative. And then I do a number of different studies of growth versus value. Growth is when you want to buy low and sell high. Value is what the market gets into when it's more defensive. And when the blue line up here is above the red line, that's positive. And this is an intraday chart based on 10 minutes. And so this, even though it fell back later in the day, this has been hanging in there. We see the blue line well above the red line now. So that's more positive on an intraday basis. Then I do a growth to value ratio on a 10-minute intraday chart. We fell off a bit on Friday, but we have been seeing an improvement here going back to about the 24th of June or so. And so for right now, this is holding in there, hanging in there and looking fairly positive. Now we break this down a little bit more. We're not seeing as much of a positive reading here. I like to keep these growth and value charts together. That's why even if they're negative, I still show them on the positive side. We're not seeing really any follow through with the growth to value ratio for the small caps. It actually declined, even though the small caps were up in Friday's session. The mid caps, which had been a stronger area of the market earlier on, they're just not showing that strength right now. You can see when the growth to value ratio was really going up. Well, now we've actually seen a death cross here with this ratio and not showing an awful lot of strength currently. This is a little more encouraging. This is S&P growth to value, and this is an end of day chart where we came down on Friday, but we have been looking better overall, and we are in an uptrend with this overall ratio. And we look at a couple of ETFs and compare growth to value that way. Even though we came down on Friday, we're still above this rainbow and we still continue to be solidly in an uptrend here. So that's positive. This is a little bit disappointing. We look at discretionary versus staples. Discretionary, this is what makes life fun, and this tends to be more of a growth area. That's Tesla and Amazon. Those are the things that really make up the discretionary sector. And then staples, think of toilet paper and toothpaste, the things that you have to have no matter what's going on in the economy. Well, we've been going sideways with discretionary. We've actually seen a little bit of a decline with staples, and that's why this ratio has been going up. We want to see this continue. That would be more positive, but we want to also look at the context as to why is this ratio going up. And we're not really breaking out above these previous levels yet. This has been a disappointing sector for the market in 2024. And we look at other growth to value ratios. We compare the Qs to the S&P. We're above an advancing moving average. That's positive. We are above the moving average with discretionary to the S&P, but the moving average itself is declining. And when we compare large cap growth with large cap value, we are still looking positive there. So we look at the large caps, which are doing okay, just a little bit above an advancing moving average with the mid caps and dropping below the moving average with the small caps. Then we want to look at the condition of the short-term trend. And I use a 20-period moving average for that. Some people use a 21-day, some use a 5-day, a 10-day. I just settle on a 20-day. That gives it a little bit more room to actually work. This is a double and triple exponential moving average based on 20 periods. And it creates a blue line and a green line. And yeah, we're falling below both of the lines right now, but we haven't necessarily rolled over with the lines themselves. So for right now, this is positive. This suggests that the short-term trend is holding together. But if we see more weakness and we continue to fall from here and these lines roll over, that's going to put the short-term trend in jeopardy. Then we look at more of an intermediate term study, a 50-period double and triple exponential moving average. We have a red line and a blue line here. When the red line is above the blue line, that just means we're going up faster because the triple goes faster than the double. We've been staying above both of these lines as the S&P has been going up, but now we fell back down. We're actually a little bit below the red line, but we're still above the blue line. The same thing with the 20 period is true here. If we continue to fall down below this and see these lines roll over, that's going to cause us some concern with the intermediate term trend. But if we continue to go up, that'll keep the intermediate term trend more intact and positive. Here is a regular 20-period moving average. This is what a lot of people tend to use. I plot both a simple, which means all 20 periods are counted the same, and an exponential moving average, which weights it more towards current price. And we're still above both of these lines, even with the decline on Friday. We're going to be watching this, though. We want price to stay above this. And this is really what I use to determine the short-term trend, if we're above or below, and then what direction are the lines going. I plot a number of different moving averages on this chart, and we're above all of them. And all of the lines are going up on all the different time frames. So this just suggests that the trend is still positive. Then we look at the 20, 50, and 200 period exponential moving average just based on the S&P itself. And even with the down day, we ticked up with the 20, 50, and 200. So that's somewhat positive for now. We look at a cumulative advanced decline line for the NYSE. I also look at the broad market, but I'm trying to whittle it down to the S&P, which is more specific here. And we actually bounced up off of this moving average with this advanced decline line. We're also still above the moving average with a regular NYSE advanced decline line. And then I have another NYSE advanced decline line, which is calculated in a slightly different way. It's still above the moving average. So the broad market is still holding up for right now. And we look at the common stock for the NYSE based, looking at the advanced decline line based on price. We did go up a little bit after we had been declining here. We're also starting to go back up when we look at this based on volume. So we're hanging in there for right now. And then we look at this for the S&P 500, cumulative based on price, not really breaking out, but not really falling down. What's a little more encouraging is the cumulative based on volume. We've been chopping sideways as the S&P has been chopping sideways as well. So this also suggests that volume is holding up, at least for right now. And then I have two different studies here that are combined. They're derivatives of each other. This is the S&P 500 new highs minus the new lows, and this is just the daily value. That's the jiggly line black that you see here. And we're positive since we're above zero. And then I have a red line in here, which is a 50-period moving average. Well, that's really hard to see, so I break it out and display it down below. Now, we're above zero, so that's positive, but we have been declining here, and that's causing us some concern. Then this is a weekly chart of the S&P 500, and this plots the pivot points. And these pivot points that are on this chart last for an entire quarter. And so far, we've been above this R2 level right now. We closed at 54.60 at this level, and we closed at 50. Okay, this line is at 54.51, so we're 9 points above it. And that's 2 weeks now that we've been able to get above this R2 level. Now, if you don't really think these are all that important, there are times when these really become majorly important. Back in 2020, we were just screaming to the upside. And then right at the end of 2021, we hit one of these pivot points, and that was the high that we saw for quite a while. And then we bounced into 2022, where we went into a cyclical bear market. We finally came up out of that. And then about a year ago, in the summer of 2023, we came up to another one of these, hit that, and then we fell about 10% from that level. We finally have been able to get back up. We were dealing with the R1 level for quite a while. We went above it only to drop down below it. We finally broke back above it again, and now we're dealing with the next level higher. So this is still positive for the time being. Then we look at those stocks inside the S&P that are above or below their 20-period moving averages. We're just barely above 50. So we had dropped slightly below 50. That turns this indicator negative. Going back above 50 turns us slightly more positive. Then we have a different study that we look at based on the 20 periods moving averages inside the S&P, where we are coming back up. Now, what we're watching for is last April, we came down and had a really extreme negative reading. And then not too long after that, we shot up out of that and actually had an extreme positive reading. And then we fell back, and we've been chopping around and really haven't seen an awful lot of follow-through strength yet. We're comparing that to what happened last March in 2023, so over a year ago, where we had an extreme negative reading. We saw an up thrust here, and yeah, it danced around and even fell negative, kind of similar to what we're seeing now. But eventually, you can see what happened after that with the S&P itself. We're wondering if that same kind of thing is going to happen this time. Then we look at those stocks in the S&P above their 50-period simple moving average. We're barely negative here, but I want to keep all these charts together in this particular study. And this is more threatening to the intermediate term trend. We want to see this go back above 50 to stay positive. If we continue to drop further below 50, that's going to turn the intermediate term trend more negative. But then we look at the 100 period, and then this is more intermediate to somewhat long term based on 100 periods. We're above 50 and we actually advanced a little bit on Friday. So that's still hanging in there. And the 200 period moving average study, quite long term, that's actually going back up. So the 100 and 200 period moving averages studies are still looking positive. We look at a ratio between staples, things that you like toilet paper and you have to have, and then we compare it with tech, which is the sector that everybody likes to get into to buy low and sell high. When this is going down, that means staples are underperforming the tech sector. And that's what we're still seeing here. We bounced back up when we went through some difficult times back in April and into the early part of May, but we've resumed a downtrend here. And I plot some moving averages to show that this is declining. To be more positive on the market, we want to see this ratio continue to decline. Then this ratio we want to see go up. This is S&P. That's what we calculate first. That's why we want it to go up. Compared to the utilities, when this is going up, that tends to be more positive for the S&P, and that's what it's doing currently. This one we want to see going down because we put staples first in the calculation. This is staples to S&P, and this continues to decline, and that's positive for the S&P. Then the parabolic SAR, this is a primary indicator as far as I'm concerned. It's one of the main indicators that I look at. When the dots are underneath, that's positive. And we're still seeing a dot underneath, even though we closed right down about on this dot. Now, I will tell you that somebody that I'm acquainted with has another chart showing the parabolic SAR, and they already see a dot on top on their chart. So any more weakness, we might see a dot come in and actually go on top. If we see a little bit of strength going up from here, then the dot should remain underneath. Then looking at the bullish percent index, this is another indicator that I really like. It's not moving average based. It's measuring the point and figure buy or sell signals inside of the S&P. When we're above 50, that means there's more buy signals. And we're seeing that right now. So we are positive with this indicator. The warning sign is that we're not really shooting up. We've been seeing the S&P going up, but the bullish percent index has not really been rising all that much either, as just a handful of stocks have really been driving the indexes higher. But for right now, this is positive. If we see weakness here, of course, that'll turn us more negative, but we want to see this continue to go up to remain more positive. Vortex, another indicator that's it's near the bottom of my primary list here because it's pretty simple to interpret. You have a green line, you have a red line. Green line's positive, red line's negative. The green line's on top, but it's declining. And so that's causing us a little bit of concern, but it's still positive for the time being. And we look at the bullish percent index for the NYSE. We are declining, but we're still above 50. We want to see this turn and go up to be more positive. Then the NYSE McClellan oscillator, we just barely crossed back above zero. That's the dividing line here. So that's turning a little bit more positive. And then based on that is the summation index for the NYSE. It's really hard to see, but we're just barely ticking up based on price and barely ticking up based on volume. It's really, you would think by just looking at this that they're still going down, but we are seeing a little bit of an improvement in this chart. Large cap growth just coming off of setting an all-time intraday high, but not necessarily an all-time closing high. We look at the large caps versus the small caps. We did come down where the Russell 2000 index was rebalanced on Friday, and the small cap saw a little bit of positive action. So we're seeing this ratio dropping slightly. The NASDAQ seems to really play into these pivot points. These are daily pivot points. And we were able to get above it on Friday, but we weren't able to stay there. We actually closed down below it. You can see other times when we came right up to this pivot point and then it dropped. The cool thing about pivot points is they're on the chart already. You can see that there's already pivot points lined up for the month of July. So we can see those well in advance. But we want to see this go back above and get above this pivot point here and break this previous high to keep more of a positive stance on the NASDAQ. And we're seeing a very similar thing here with the NASDAQ 100. We got above the pivot point only to close down below it. We want to see this going back up to stay more positive. Now, we are positive on a trending basis. The blue line's above the red line, and we've been in an uptrend for quite some time. But if we pull back, we'll be watching to see, does it come down to its 50-day moving average? We look at the bullish percent index for the NASDAQ 100, which finally crossed above 50 about a week ago. This is continuing to go up, and that is positive. The Wilshire, a broad market measure that we look at, set an all-time intraday high, but closed well off of that, not at the low, but near the low. But this is still positive for the broader market. Another broad market measure is the total US stock ETF, coming off of just setting recent all-time highs on a closing basis and did set an all-time high on an intraday basis on Friday. The FANG index, Facebook, Apple, Amazon, Netflix, Google, Nvidia is in there somewhere too. It set an all-time intraday high, but then closed pretty much at the low, but it's still in a longer-term uptrend. The semiconductor is a huge part of the tech sector. Had been seeing a pullback as some profit taking was coming in. We're still in a positive trend. We were up over 1%. We want to see this continue to go up if tech is going to keep helping the market to go higher. Then down below, I have a relative strength ratio, which has been declining, but it's still above 100. So it's positive, but showing some weakness, where the relative strength momentum is actually dropping below 100 as it's picking up some of this weakness that we've seen. And this is relative to the S&P 500. We want to see both of these lines turn and start to go back up to be more positive. The tech sector, very similar thing here. The darling sector that everybody loves, just coming off of setting recent all-time highs, still in a solid uptrend, but we're seeing a little bit of weakness with the relative strength as well as the momentum as of late. And we look at the tech sector and compare it with 3 to 7 year bonds. And this just shows that the tech sector is outperforming the price of 3 to 7 year bonds. And then we look at the S&P and compare it with 3 to 7 year bonds. And when we're up where we're at right now, you could say that the market is anticipating a soft landing, which means that we'll not go into a recession. A hard landing would be if we do go into a recession, but that's what the market has been pretty much figuring in here since we hit the lows back in late 2022 and into 2023. And we look at 3 to 7 year bonds and compare them with stocks. This is kind of an inverse of the chart we just looked at. With this ratio going down the way it has been, that's more positive for stocks. And we look at a weekly chart of the NASDAQ 100 going back to 2009, and there's a trend line. We're still looking good longer term. Then we do another chart with the ratio of the NASDAQ 100 to the Dow, which it came back to this high that was set back during the dot-com boom, and then we crashed, and then it took us many years to get back up here. We hit this same ratio again, only to fall back into 2022. Well, now the strength in the market has actually taken us above this, and we're showing a new high with this overall ratio. We do that same thing with the QQQs, which is the NASDAQ 100, to the small caps, also breaking out above these previous highs that have been set for decades now. And this is really showing some strength, even though it pulled back a bit on Friday. Semiconductors to the Dow, also breaking out. It did come down a bit here, but we're above this blue line, which is the previous high that was set. If we continue to fall, yeah, we'll be watching that to see more weakness coming into the market. But for right now, it's hanging in there. And then we look at the QQQs to 3 to 7 year bonds, still hanging in there as well. The Qs are outperforming. We look at the S&P 1500, another broad market measure, and compare it with shorter term bonds, showing that stocks are outperforming. Another broad market measure with 3 to 7 year bonds, also stocks continue to outperform. And then this is kind of a new slant on Dow theory, where instead of using the Dow and the top part of the chart, I use the equal weight S&P 500. That's more of a representation of the U.S. economy. And instead of using the transports, we use the QQQ equal weight. Now, there's some positive things and some negative things in this chart. The negative thing is that we have not set an all-time high with the S&P equal weight index, and it's really been underperforming the S&P as the big stocks have really been leading the index higher. But we are looking positive overall, but we're just not setting an all-time high yet, where the QQQs are coming off of setting maybe not an all-time high here, but it was close. And so that's more on the positive side. We just want to keep an eye on this to see how the market is hanging together. Now we look at the negative side. Now, when I measure sentiment, and this is the CNN Fear and Greed Index, when we're below 50, I kind of have to put that into a negative camp. We've been seeing sentiment acting weird. Sentiment was actually going down as the S&P was going up, and a lot of that has to do with the negative divergences that we've been seeing that are used to calculate this particular index. And we're continuing to decline here. And since we're below 50, that's why this is on the negative side. This is another well, it's right on in between primary and secondary indicator for me, because sometimes this indicator can be right on and other times it can actually lead us astray. This is the Swenlin trading oscillator, where we had been positive, but now we're starting to drop below zero based on price. We're just hanging in there positive based on volume, but we are seeing some weakness. If we continue to drop down below, this will turn even more negative. Of course, if we go back up, this could turn back and look positive. Then we look at the S&P McClellan oscillator. Now, earlier I showed the NYSE McClellan oscillator. That's a broad market measure. This is just for the S&P itself. We are showing an improvement, but we're still below zero. So that's negative. And then based on that, we still see the summation index declining based on price and volume. They're slowing down a little bit here, but we want to see these lines turn and go up to be more positive. Where the McClellan oscillator, that's more short term to slightly intermediate term. The summation index is more intermediate term to somewhat long term. Now we're seeing our momentum oscillators rolling over, and I look at a lot of momentum oscillators. I have two short-term oscillators, and we're starting to roll over with the slope, and we're above this green line, which means we're getting an extreme positive reading. You can also see a negative divergence here. We were going up with the S&P. We made a lower high here with the slope oscillator. We're pretty much flat, but still looking positive with the TSI. Those are the short term. Then I have three intermediate term. The MACD, which you're probably familiar with. That's one of the first indicators based on momentum that people learn about. At least it's the first one I learned about. We're starting to cross back below the moving average. The PMO is flattening out, but still above its moving average. It's starting to cross below the moving average with the PPO. Then I have two long-term oscillators, the TRIX and the KST. We're rolling over, but we're still positive with those longer-term oscillators. Then we look at a broad market measure, the Amex, NASDAQ, and NYSE. We look at the 5-period moving average of the highs minus the lows. We're below zero. So even though the broad market's holding up a little better, we want to see this cross back above zero to be more positive. The mid caps, where back in January and then into April, this thing was just really helping the market do better. It's been chopping sideways and can't even get above its 50-day moving average right now and can't get above this pivot point. So this is causing us some concern. And then our advanced decline lines. We're looking better with the S&P, but we're still below the moving average with the NYSE common stock, the mid caps, and the small caps. Even though they have been improving, we want to see all of these lines above the moving average and the moving average continuing to go up. NASDAQ 100, even though it's positive, we're starting to turn negative with momentum as measured by the PPO. We're crossing below the moving average here, and this is starting to decline, and that's a little bit of a concern. Then we look at the S&P and compare it with the equal weight S&P. And this is more negative than I'm seeing right now, because this is when this really goes up the way it has been, that means there's a small group of stocks. Now, if we're really going up with the S&P, that would be more positive. But we're just kind of chopping around right now. And we're a little bit, at least I'm a little bit concerned about, we need more broad market participation inside of the S&P, not just a handful of stocks that really drive the market. Because if those stocks come under some profit taking or actually some weakness, that's going to send the whole index down. And we look at the 10-year yield, and this had been positive as we were declining with interest rates. Now we're starting to go back up. Now we're coming right back up to the 200-day moving average, and we haven't been able to clear above that yet. If we can continue to decline with interest rates, that'll likely be positive for stocks. Then we look at 1 to 3 month T-bills, which you could pretty much call cash, and we compare it with the 3 to 7 year bond. We want to see this ratio going down to be more positive. It's going back up, and that is causing us some concern. When this goes up, that means there's uncertainty about interest rates and inflation. And we're seeing a lot of that right now. We look at 1 to 3 year bonds and compare it with 3 to 7 year bonds. We want to see this ratio going down to be more positive on inflation and interest rates. This is starting to go back up again. Another measure, looking at TIPS, which are Treasury inflation protected securities. When these are outperforming, that means folks are concerned about inflation and interest rates going up. We did start to decline, but now we're starting to go back up, and that is causing us some concern. Then we look at home construction, which is a very interest rate sensitive area. We've been holding up for a lot of 2023 into 2024, but now we're starting to break down and coming into the rainbow. This isn't as positive as it had been. And we look at the Eurozone. They're having some political unrest there, specifically in France with what's going on with their election, and is France going to leave the EU? I really haven't kept up with that situation, as things in the US have been kind of at the forefront right now. But we're coming down into the rainbow when we look at the Eurozone and compare it with American 3 to 7 year bonds. Earlier on, we were seeing this well above the rainbow and holding up a bit better. Now it's starting to show some weakness. Now, the reason I do this is a lot of times things happening in Europe will precede those things that happen in the US. Look at technology, look at fashion, sometimes economically that can happen as well. Where on a very general basis, sometimes Asia tends to follow what happens in the US and with fashion and with technology. But there's always exceptions to that, but it's kind of a general idea. And then we look at the staple sector. The reason I've been watching this is the area of the market where you have things you have to have no matter what's going on economically. This has been in a really solid uptrend, and when it pulls back, it still has been staying above its 50-day moving average. This is a more defensive area of the market, and we're seeing down here a bit of an improvement with the momentum and the relative strength down below. But this is what happens when the market is getting set up for a decline. You can see it was really going up in 2021, and then it held up better in 2022. We're wondering if something like that is unfolding right now, as the market possibly is turning more defensive. And we're seeing that same kind of thing with utilities. Now, with utilities, it may be because they just need more electricity and the utility companies are doing better. But this is also an area that typically gets strong when the market gets ready to be defensive, which often means a decline. We did decline down here well off of the highs, but we're still dealing with the 50-period moving average. We're seeing a little bit of strength in the momentum, but we're falling down when we look at the relative strength ratio with the S&P. Then this is a weekly chart of the NASDAQ 100. And the reason this is negative is we've had two almost doji-like candles where we opened and closed the week before pretty much the same spot, and we opened and closed at pretty much the same spot this last week. We want to see this going up. And you can see we don't see these happen very often. Are these two really thin candles here? Is that setting us up for some kind of a decline going forward from here? Or are we just resting right now before the cues get set to go higher? We don't know that yet, so we're just keeping an eye on that. When we look at the dollar, and it's still in an uptrend, and when the dollar's in an uptrend, that tends to put pressure on stocks. The stock market likes a weaker dollar for conversion rate purposes. It's more friendly to the dollar. And for import-export relationships, that also is more friendly to US stocks. Thank you. I really hope you found this helpful. I hope you're having a wonderful weekend, and I will talk to you in the next video.